Good afternoon. I'd also like to welcome you to AmeriCatalyst 2011 webinar series, Great Debates in Housing Finance. Thank you all for being with us this afternoon. This series of quarterly webinars are part of the run-up to our 10-year anniversary of the annual AmeriCatalyst conference, which is being held in Austin, Texas this November 6th through the 8th. I hope you'll be able to join us, as it will certainly exceed anything we've ever done before. I'd also like to sincerely thank Field Asset Services and CoreLogic for underwriting the cost of this webinar in order for you all to participate at no charge. Since our U.S. launch in 2009, FAS and CoreLogic have been our largest supporters, allowing us to continue to differentiate our events by their actual purpose and not their profit. Just a couple of housekeeping issues. You can listen to the discussion from your telephone, but please turn off the volume on your computers to avoid a slight delay. Second, to let you know in terms of timing, our webinar will continue for an hour and 15 minutes. Third, tomorrow we'll send an email to all of you containing links to listen to the webinar once again if you're unable to stay for its entirety today. You'll also be able to download today's presentation and recommended reading materials. We'll test you on them in November, and Elizabeth Warren will be grading your tests. Since we didn't have our call this morning, let's see, you will also have access to the video and slides early next week. So, hope you're aware of that. Although we do have slides that aspire to the heights of Lori Goodman, those of you who know Lori know what I'm referring to, the tone of today's webinar is very conversational. So we welcome your questions, and as I see exceptionally good ones come up, I'll pose those questions without revealing anyone's identity or affiliation, so don't be worried about that. For the past 14 years, I've been on a mission to educate our industry on the impact of globalization on the housing finance industry, as well as the globalization of housing finance itself. I'm referring to globalization as the expansion in scale, the increase in magnitude, and the acceleration of the flow and impact of ideas, of communications, of information, currency, trading, culture, and crises across borders. These forces affect every layer of housing, not just the economic, but the individual, social, cultural, and political as well. I would argue that the changes are so great that we no longer have any historic precedents, as the lives and challenges that we face today have little to no relevance to the past. If you think about how often you hear the word unprecedented today, you get a very good idea of what I mean. What happens from this point forward is nothing but a massive social experiment. Really think about that. It's all an experiment, and we have no idea what the outcome's going to be. And anyone who says that they actually know the outcome is either deluded or running for public office. Which brings me to today's topic, the war is over, will servicers survive the ongoing battle? I'm honored to have Amy Brandt and Adam Levitin join us for the discussion today. Amy is the CEO of Vantium Capital, which is a portfolio company of Apollo, one of the nation's largest private equity firms. If I could summarize, Vantium is a specialist in economic remediation, with a life cycle of operating businesses that include Acura Loan Services, which is a special servicer, Strategic Recovery Group, which recovers debt for charged-off assets and distressed debt, and Velocity Capital Defense, which assesses the validity and legitimate defense of loan repurchase requests. Amy's an entrepreneur with a degree in law and a wicked sense of humor, so don't mess with her. I think it's fair to say that Amy's approach to today's discussion is an industry insider looking outward at the astounding changes both incumbent and forced upon the servicing industry. Adam Levitin is Associate Professor of Law at Georgetown University with a Master's in Philosophy from Columbia. I love you for that, Adam. And his law degree from Harvard. As a legal scholar and professor, Adam specializes in bankruptcy, commercial law, and financial regulation. His research focuses on consumer and housing finance, payments, and debt restructuring. He's also served as special counsel to the Congressional Oversight Panel and frequently testifies before Congress on the most important issues facing our industry today. Adam is a scholar and professor with a wicked sense of justice, so don't mess with him either. Adam's approach to today's topic is as an outsider looking inward at the changes that must occur in the servicing industry in order to comply with the law as it stands. As for me, I've worked in the industry for the past 20 years, and my background is in the forensic analysis of loan portfolios and special servicing. I've helped establish origination and servicing operations in 27 countries around the world, played a critical role in building continental Europe's largest third-party servicer, and am simultaneously one of the strongest advocates of the servicing sector, as well as one of its most harsh critics. And you can mess with me all you want. Before you do, I just want to show you the efforts and extent to which our sister firm, AmeriCatalyst, has gone to reposition the role and importance of servicing from our platform in Europe. When the audience at our main event, AmeriCatalyst, began throwing pillows at us on stage during the servicing sessions in 2002, that's how much interest there was in servicing. In 2004, we created a separate event called Europe Servicing. It was like pulling teeth to get people to participate in this thing, and they only came kicking and screaming. So by 2005, we used the fear approach to get their attention. And in using the fear approach, we created this ad that said, do I really need to care about mortgage servicing? And then discussed how Europe, in particular, had witnessed unprecedented growth in the mortgage market, but that portfolios were seasoning and operational losses could no longer be offset against rising house prices. So we were trying to encourage everyone to be there because the answer depended on how much they could afford to lose. So in 2006, we took a much different approach, which worked a lot better, which was to say, who says servicing isn't sexy? At least I got the investment bankers to show up. By 2008, we used the we told you so approach, which was essentially taking the same ad from 2005, crossing everything out, and basically saying we now know the answer to that one. So I thought that I was joking when I came up with a line that's been repeated quite frequently, and the line goes like this. It used to be that servicers couldn't get enough attention to get them arrested. Now everybody wants to arrest them. I seriously thought that was a joke at the time, but given today's topic, it's not funny anymore. So today we're going to talk about the volume and escalation of regulatory and legal actions being taken primarily against the top 14 mega servicers, the impact of these actions to date, the priority of the greatest threats to the industry, and an assessment of what comes next. Finally, we'll discuss some possible solutions to a situation that increasingly appears to be, as Adam Levitin recently wrote in his blog, FUBAR. If you don't know the meaning of the word FUBAR, just ask any 14-year-old and they'll tell you. So what we've done here is we've compiled a timeline of actions taken over the past 8 months, which shows an escalating trend to, depending on your perspective, dogpile on the servicers or hold them accountable for sloppy foreclosure practices at best and allegations of systemic fraud at worst. We're not going to go over this in detail now, but I wanted to provide it to you for your own reading after the webinar, and we'll continue to update it on the AmeriCatalyst website. As you can see, the actions are quite extensive and show no real end in sight. Every time I speak to someone, including Adam and Amy, the question is inevitably, hey, did you see the news just this morning? So this timeline just continues to be added to daily. Now we're going to stop here at the slide, how they line up. There we go. And what you see here are the actions from the U.S. Securities and Exchange Commission, from HUD and Treasury, from the OCC, OTS, and FRB, from the FHFA, from the U.S. Trustee's Office, from the CFPB, from the State Attorneys General, and most recently, New York Attorney General Eric Schneiderman, who's been joined by Delaware Attorney General Joe Biden. In coming up with the title of this particular webinar, I struggled with naming it Flying Over the Cuckoo's Nest, or the double entendre, Take No Prisoners, and finally settled with The War is Over, Will Servicers Survive the Ongoing Battle? What I meant by that title is that the recent OCC, OTS, FRB consent letters, which prescribe massively extensive and expensive operational changes at the largest mega servicers, essentially ended the war between the government acting as the ultimate risk manager to mitigate the systemic risks posed by the servicers and the servicers' concessions to the terms of consent. The rest of the actions being taken, I thought, were highly politicized battles waged by politicians appeasing their constituents. In the past month, I've begun to change my opinion on that. So as a first question for Adam and followed by Amy, how would you characterize what's currently happening?
Well, Toni, I'm afraid we're seeing the consequences of a failed business model. Servicing was traditionally sort of a sleepy back office side of banking. It never attracted a lot of attention before, as you were saying. And it was really built to do transaction processing. So that was a business where there were economies of scale and automation, and servicing was priced for that. The problem is that servicing has also had a default management component, a second line of business. And that is a very different kind of business. Tolstoy might have been speaking about defaulted borrowers when he wrote in Anna Karenina that each unhappy family is unhappy in its own way. Because I think that's very much the case about the defaulted borrower. Even though they may have a lot in common, they can't all be squeezed into the same automated program if you want to maximize recoveries. The only way to automate dealing with automate defaults is to automate foreclosures. And that has been done, but that's also created plenty of problems. So default management is an area that really needs it's a high-touch area, and that means it's more expensive. And as we see this failed business model, a servicing business model built for transaction processing, dealing with a deluge of defaults, we are struck with the problem of how do you change a business model midstream? And there are two problems with that. One is just an operational problem. And that's not a small problem. But then there's also the cost question. Someone has to pay for that. And if we don't, then it's not that if we don't change the model, it's not that the costs go away. It's just who ends up bearing the costs. So if we don't change the model, we have the costs being where they currently are, meaning that they are on borrowers, that they are on communities because of the sort of collateral consequences, that foreclosures depress home prices, they affect school systems, so forth. I can go on and on about that, even about, what happens if you to borrowers' pets when they relocate to apartments. They take the dogs to be put down. But leaving, we can have lots of tearjerker sad stories there. But that's where the costs lie currently. And I should also emphasize that if we don't change this business model and find a solution, we're in for years and years and years of litigation. That the litigation isn't going to go away with the consent orders. The consent orders were the punishment that servicers got from their friends. That the OCC was looking out for the servicers. It wasn't trying to ding them. And if that's what your friends give you, you've got real problems. And I would add one other point to all this, which is, so we got to figure out where the costs are going to fall. All these things are ultimately dancing around the question of who's going to pay for this mess. But it's not just who's going to pay for the mess. This is also part of rebuilding the housing finance market. And if we don't deal with the legacy problems in housing finance, we are not going to be able to bring private risk capital back into this market. Private risk capital really means credit risk investors. And credit risk has two components. It's your probability of default and your loss severities given default. And what investors have learned is that servicing is absolutely critical for determining loss severities given default. And if you're a fixed income investor, that's something you don't want to have to worry about. You want that to be just a no-brainer that you're going to get good servicing and that it's not an issue. It's just not an issue you want to be worrying about. And until the servicing space is kind of cleaned up its act, I think it's going to be very difficult to get private risk capital coming back in the market in any volume. I mean, we may see, another couple Redwood-style deals. But we're not going to see a vibrant private label securitization market unless we clean up servicing. And frankly, I'm dubious whether, even if we do, that will be sufficient, but that's another story. I think servicing is at least a sort of a necessary but maybe not sufficient condition.
Adam, you mentioned the time factor here, and Amy, I'm going to throw another wrench in when I pass this to you. The time factor and who pays the costs. And my biggest question from an operational perspective is, do we really have time to change the model while the crisis is going on right now? And ultimately, who's going to pay that cost to change the entire model? Because a lot of these servicers are too big to manage. Amy, can you address that?
And Amy, I think your phone might be muted.
Sorry about that. I think this slide is one illustration, and there are other illustrations further on in the deck, in the amount of complexity involved in default servicing. And certainly Adam is correct when he says that when the model was established, it didn't contemplate the level of default that occurs now, so that there really is an adequate revenue to cover the amount of cost required to handle both there's another slide I think Toni just put up on the doc management process and the amount of parties involved, which is true throughout the entire real estate businesses. There's always a variety of constituencies. There's a lot of documents. There's a lot of rules, a lot of T's to cross and I's to dot rather. So it makes it a really a difficult process to manage, and the industry has tried to evolve by creating special servicers really focused on the default side of the business. But so far, all the regulatory action that's been designed to address the problem, and in some instances to punish the people that created the problem, only adds to the challenges in getting those assets off to default servicers. Really, everything so far has kept the concentration in just a couple of hands. So you have a large percentage of the servicing out there concentrated with a few folks trying to manage all this.
So, Adam, would you agree that all of this really is the result of some pretty sloppy operational practices with regard to foreclosure? Is that really where all of this started? Adam's got sound issues.
You're on mute now.
Yes. And foreclosures where the problems manifest themselves, but they start actually earlier in the document chain than foreclosure. They start with the securitization process itself and the way paperwork is moved in that process. And that's not a problem. No one cares about that unless there is a problem with the loan. As long as the borrower is still paying on the loan, it's not a big deal. But it's when that we see those problems manifest themselves in the foreclosure process.
Do you think that, I had read one of your blogs and you had actually said that you didn't think that a lot of this was malice, but that recently you've begun to change some of your opinion in terms of how systematic a lot of the problems truly are, and that it's a result of cost cutting.
Well, yeah, what sort of elicited that comment from me was reading a court order out of Florida related to an allonge. And in reading this order, it was absolutely clear that someone was forging an allonge. Where that was happening in the document management chain was not at all clear to me. If that was local counsel, if it was the foreclosure network firm, if it was a vendor, if it was the servicer, my sense is it's probably farther downstream than upstream. But that, and seeing that, after I did that post, I received more emails on that than I have from any other blog post I've ever done, of borrowers and attorneys just telling me allonge story after allonge story, where they say these things are just being made up wholesale, and that it's hard to discount that. I mean, I get enough emails that I feel I can distinguish between your kind of nutty pro se cases who are arguing that, this is all about the gold standard in the Federal Reserve and the Trilateral Commission, and the ones who actually have some issue to gripe about even if they haven't figured out how to express, the proper terms to express it. And also attorneys who I know who I take rather seriously saying this is a problem we see routinely. It makes me very concerned that we don't just have a problem of robo-signing, where, if someone signs an affidavit where they don't have personal knowledge, I don't think we have a lot of harm there. But when you have people making up legal documents that after the foreclosure cases started, that's a very troubling thing. I think that takes it to a different level when you have document creation. And I don't know if that's malice, but it strikes me as going beyond, the problems of that there's a failed business model that, well, gosh, we just, we're just not going to, didn't do the paperwork in the first place. We're trying to cover our ass because of the failed business model, and ultimately that only digs the hole deeper.
Right. Actually, let's, Shirley, if you can pull up the consent order slide. Okay. This is where I felt that the war was over, and there's quite a bit required, to say the least, required of servicers to comply with. But in particular, Adam, I wanted you to point out what's missing from this.
Well, I think so let me take that question a little differently. As you know, there are a lot of operational changes here. That being said, they're not particularly detailed. So, if you look at the way you summarize a single point of contact, we get 12 different requirements. But then, if you go back and look at the way, there's not a definition of single point of contact in the orders. And the original, there was a draft copy of these orders that got leaked out a little earlier. And in the draft version, it defines single point of contact, and it said single point of contact which need not be a single person. In other words, a single 1-800 number would suffice. Well, that's not much of a single point of contact. The new version talks about single point of contact as defined herein, and then has no definition. My sense of these orders is that it was very much kind of a Potemkin village approach here. It was to say publicly, look, we are going to, you've been very bad servicers. We're going to punish you, and then the punishment is actually pretty vague. And critically, compliance with it is entirely non-public. That all the reporting that is done under the consent orders is to the federal bank regulators. It's not public reporting. And it's in the federal bank regulators' sole discretion whether there is compliance or not. There's no one else is able to judge that. And if you look at maybe what might, in theory, could have been the most important part of this, which is having an independent foreclosure consultant who is going to, so this foreclosure review is the bullet point you have here. It says retain independent consultant to review foreclosure files within this kind of 2-year window. The problem is that the servicers are choosing their own consultant. That's a lot like choosing your own auditor. And who are you going to choose as your auditor? You're going to choose the auditor who's going to, let you slide when it's close. Who are you going to choose as your foreclosure consultant? Well, presumably you're not going to choose the guy who has the reputation of being a hard ass. You're not going to, get me to be the foreclosure consultant. You're going to get someone who's quite blind. So one large servicer had already started having independent foreclosure reviews. And who did it choose? It chose a law firm that handles a lot of its foreclosures. There's inherent conflict of interest there. So I think that this is it's a lot of sizzle, not so much steak. It's going to create, and really in terms of what's the benefit of this, it's going to cause an awful lot of operational pain in the ass for servicers, and I'm not sure what the benefit is going to be here. And maybe the benefit is this buys peace with the OCC, but the OCC was willing to have peace for a penny too.
Well, sorry, Amy, go ahead.
I was going to ask Adam, even in the reviews leading up to this consent order, wasn't it pretty well acknowledged that they didn't find very many instances of wrongful foreclosure or, any borrowers that were actually suffered a loss as a result of these processes? Two points in response to that. One is the methodology that they use in actually looking at files has been pretty roundly criticized, just in terms of the size of the sample and what they were looking for. If you don't look for a problem, you're not going to find it, right? In terms of the actual number of wrongful foreclosures, I can't remember what the actual findings were there, and we may not. I think this takes us to a very important thing. There's the question of, do you have homeowners who got kicked out of their homes who were not in default, versus do you have people who were in default who lost their homes but maybe procedurally, wasn't according to Hoyle. And I think it's important to distinguish between those problems. There have been some cases that people have found, not that many, but some cases, of homeowners who were not in default who were foreclosed on.
I can't, I don't have a number there for you, but it doesn't seem to be a huge number of cases. And those cases are disturbing, but they're not. That doesn't seem to be the typical situation. Instead, the more typical situation is where you have a foreclosure, where the borrower is in default, but something in the foreclosure is not kosher. Something with the paperwork isn't right. And therein lies kind of the critical problem.
Your comment about this being an operational pain in the ass is such an understatement, because the servicers just had to tailor all of their systems to comply with the failed HAMP program. Now they've got to redo their systems once again. Many of them don't even have enough space, literally, for the new employees to sit. And there's a point at which it just completely paralyzes the system. I'm not an apologist for the servicers and the mistakes that they've made, but on the other hand, this is just unbelievable.
Well, it seems to me like they're focusing on the area where there's the least amount of problem, and when I think what they're trying to get to, or, Adam, you can comment on this as well, is that really trying to force more people back from foreclosure and doing other resolution strategies outside of foreclosure.
I think that's exactly right. And I think this has been the point where there's been a lot of conflict in this area. So we have the area where we have problems are what you might call procedural. I as a law professor, I take procedure kind of seriously, but it's procedural more than substantive. But those procedural issues are being used as leverage or by regulators to try and achieve different default management resolutions. They're trying to use procedural problems to leverage loan modifications, leverage workouts, and that, I think from the servicer's perspective, that's been kind of confusing. Because if you're a servicer, you look at this and you say, wait a sec, yeah, I screwed up on some procedural stuff, and, no one really got hurt with this stuff. Why does that translate into a loan mod? What does one have to do with the other? And I think that criticism is exactly right, but I think the response from regulators and from litigants is, well, that's the leverage I have. That's the tool here, and if you screw up in Area 1, that gives me a tool to use to force a different result in Area 2. And they're not directly connected.
Right, but we already, I think you mentioned earlier that the cost structure and the incentives and revenues are out of line. So servicers are probably underwater, at least most are. And when you look at the MBA studies on cost, you can see that the profit margins are pretty thin. And when you count for the depreciation of MSRs, most servicers are running losses. So now we're asking them to shift a great deal of cost and resource to maybe the part that doesn't solve the crisis as well as other parts could. So I just wonder if it would have been better to try to focus on how can we drive more resolutions, how can we get more loans to modify, or if they don't want to stay in the home short sale, any number of other resolutions. Because if we go through foreclosure, I think we saw in the journal the other day, it would take 60 years to resolve this problem. So I would think that by and large we'd be better served to put our dollars in that area.
I couldn't agree more on that, but and unfortunately the consent orders have no interest in achieving foreclosure resolution. Instead, their interest is simply ensuring that that everything is operationally sound. And I think part of what animates that is that if you do have more workouts happening, you do have more modifications, that might start to expose the situation of on financial institutions' balance sheets. That if they have to start carrying some of these loans at their actual market value, and until you sell it out of REO, you can kind of carry it at whatever you want. There's a lot of room for accounting mischief until the REO sale. That this is a way of, in some ways, protecting the banking system from having to recognize losses. And that's a dangerous game for bank regulators to play, because as long as investors believe that bank balance sheets are not clean, they're going to be hesitant to jump into that space unless they think that the federal government is backing those banks. And try as it will, the federal government hasn't convinced anyone that it's not backing the large banks. But I think ultimately that should be our goal, is to have in our large financial institutions without this federal backstop.
Adam, we talked about the lack of resources for the largest servicers and how they're really scrambling to put those resources on board. But I'm also really curious, especially with the work that you do in Washington. First of all, how well educated are the regulators in terms of actually understanding how the servicing business works? And secondly, now there will be all of this oversight. The servicers have to provide all of these reports. What kind of capacity do regulators have to actually oversee them?
Oh boy, I think certainly if you rewound to last fall, the amount of expertise and knowledge in federal regulatory agencies on servicing was close to zero. That you had some specific pockets of knowledge within, let's say, FHA or Ginnie Mae dealing with their own servicers. And, I want to be clear to bracket Fannie and Freddie as not being part of the federal government. Outside, the bank regulators, the OCC, the Fed, OTF, virtually no expertise in servicing. And servicing was not an area that they paid particular attention to before. As I said, this was kind of a sleepy backroom operation. And I think there's been a lot of learning that's been happening, but there still is not sort of a deep body of regulatory knowledge. And it's even thinner, I think, when you get outside of the agencies and go to Capitol Hill, for example. That Senate Banking Committee staffers have been scrambling to try and understand servicing, but there's a lot of learning to do. And unfortunately, there aren't a lot of great resources around that explain the servicing industry very well. I think some of the slides here are, do a great job of pushing things forward. So I think there's an effort to learn, but there's a lot of learning still to be done. What I think where this is going to become interesting will be on after July 21st. So if nothing changes in Congress, on July 21st, the Consumer Financial Protection Bureau will be up and running. It doesn't have a director yet, but until at least on the 21st, if there isn't a director who's been appointed, the Treasury Secretary becomes acting director and has limited powers for the CFPB. Those limited powers do not include the ability to carry on examinations of non-bank lenders. I can't remember off the top of my head where so-called bank service companies, as many servicers would be categorized, would come in. But there will be some ability to regulate servicers, at least under things like existing statutes like the Fair Debt Collection Practices Act. And whenever we see the CFPB actually have a director, we will then have an agency that has a clear mandate to regulate the servicing industry. And it's hard to believe that servicing will not be among the first issues that CFPB tackles. I don't think this is the issue that people involved with CFPB wanted to have to deal with, but this is the elephant in the room now. There's no way to avoid dealing with servicing for a consumer protection agency.
Does that mean that the CFPB will be the sole regulator of servicers?
No. CFPB will be regulating the servicers. Well, let's start with this. This in part depends on what kind of entity the servicer is. If the servicer is a bank itself, then the answer is no. If the servicer is a non-bank, it's just a regular state corporation, then functionally yes. There may be some overlapping state regulation, but on the federal level, then the CFPB would be the sole regulator.
Adam, do you believe that the CFPB will be pushing for uniform servicing standards?
I think that ultimately that will be the case, and I think I would hope from the servicing industry's perspective that there would be a lot of interest in having uniform standards, and even broadening that into something on the lines of uniform foreclosure law. That I think there would be a lot of disagreement between servicers and consumer groups as to what that should be. But having one set of procedures that governs everywhere would certainly make life a lot easier for servicers. We have a national mortgage finance market, yet we have local foreclosure markets, and that just doesn't make sense.
We're getting a little bit out of order from our structure, so I wanted to kind of go back for a second. If we can look at slide 20, Shirley, and Amy, if you could address that slide about how the servicing industry will address the operational and procedural challenges. And then, Adam, I certainly want to come back to the CFPB because I realize what a big issue that is. So we'll work our way back there in a minute. Amy, can you go ahead and address this slide? And part of the reason that I'm asking you to do this is because the focus and a lot of the problems, arguably, are on the mega servicers who, for lack of a more neutral term, were responsible for causing the problems. But the smaller and more specialized special servicers who are better equipped to deal with these situations are essentially painted with the same brush as the mega servicers and are forced to comply with the penalties imposed upon the big guys. So my question for you is, do the non-mega servicers actually have a voice? Do you have a seat at the table in these discussions? And how do you differentiate from them? And does Washington even know you guys exist?
I guess I would ask Adam if Washington knows we exist, but I would suspect not. And we certainly, as a group, have not had much of a voice or a seat at the table. To date, we've really been kind of stuck behind the dialogue of the larger servicers. And the focus has been on them because they have so many of the assets. So regulators naturally are going to, go to them to solve the greater problems. In the meantime, the industry sort of reacted and created these special servicing models to really be focused on defaulted loans and to have a much higher employee-to-loan ratio, developing technology, investing in processes, and things to address a highly delinquent portfolio, yet really not, I don't think, been introduced in a great amount yet as a potential solution. So some of the special servicers have now gotten together and we're working on creating a special servicer alliance, not to have a trade org, not necessarily for any other purpose than to just make sure as a group we're getting our voice heard and that we're getting a seat at the table. All these orders are eventually going to affect us. When we, see this stuff, we know it's going to end up in probably national servicing standards, or at the very minimum, these will be expectations that we're going to have to comply with as well. So it's pretty frustrating not to be part of that dialogue in any way.
Adam, does Washington know that the special servicers exist?
No.
Wow. and given the amount of lobbying going on at all these organizations, what is it going to take?
People who deal with servicing on a daily basis are aware that special servicers exist. But when you get up to to their principles, the answer is no. That special servicers have not had a seat at the table. They have not been, they haven't been represented as part of really as part of the settlement talks. That this has been, the servicing issue has really been focused on particularly the 5 biggest servicers. And to some extent, maybe you expand that to, a big 8 or a big 14, but it's really about the big 5.
Amy, let's go back to, wait a second, Adam. So what is it going to take to educate them in Washington about the special servicers? Nobody wants to talk to lobbyists, so is the door open for the special servicers themselves?
Oh, no, that's not true that nobody wants to. Maybe that nobody wants to talk to lobbyists, but they certainly spend plenty of time talking to them. And part of it is simply, some shoe leather, getting out, having special servicers or a trade organization for them, getting out there, making contacts with people in the agencies and on the Hill, talking with them, getting just an informational campaign so that they know that, first of all, the special servicers exist, secondly, what they do, and thirdly, that they have different interests, capabilities, and incentives than the mega servicers. And that, that to the degree that special servicers can be part of a solution, explaining how that works. But doors are certainly open to lobbyists. And I'd say maybe more so at CFPB than anywhere else, because CFPB has been bending over backwards to show that it is, willing, that it's willing to listen to industry, that it wants to understand industry concerns, and that includes not just large financial institutions, but smaller ones.
God, that message isn't getting out very well because there's so much fear surrounding the CFPB and so many falsehoods being spread about it that it's just frustrating to watch, frankly. Especially was that actually a confirmation hearing when McHenry attacked Elizabeth Warren and called her a liar?
No comment on that. That was just terrible.
But was it a confirmation hearing?
No, it was Professor Warren was testifying solely as a voluntary witness. She was under no legal obligation to testify. It wasn't a confirmation hearing. That she was doing it as a courtesy to the House, the testimony. And I mean, politically, it's a smart move to go and testify if you're in her shoes, but she was under no legal obligation to do so. And the way she was treated, the disrespect with which she was treated there was pretty staggering.
Wow. Amy, did you happen to see that?
No, I didn't see that.
Yeah. Well, Amy, I encourage everybody to YouTube that. It's quite a spectacle of how ridiculous politics have become in this country. Anyway, getting off of that topic, Amy, can we go to the slide, Large Servicers Too Big to Fail, so that you can introduce the special servicing perspective and how you could potentially be part of the solution. And then we're going to go back to some of the actual issues that we're discussing with regard to the CFPB and the Attorney General suit and then the Schneiderman actions.
Yes, I mean, I think it's incumbent upon the servicing industry to introduce solutions and potential solutions rather than wait for actions to be taken against them. So we have to find business models that do work. We have to retool our business models and fee structures to align interests and to make a proactive move here. Otherwise, things are just going to continue to be imposed upon us that may or may not be workable. And I think when you look back at what is wrong with the servicing model, you can find it's not hard to find a lot of things. I've highlighted a few here. Number one, it's not investor-centric. The servicing rights are often owned separately from the whole loans. There's competing interests within bond classes. For example, you may have the mezzanine or sub-bonds wanting to do mods so they can maintain cash flows and keep from trigger fails. And you have the AAA bonds that could benefit from trigger fails that would cause all the cash flows then to go to them. So you have within classes of single securitization inconsistencies on the same debt and what the interests are and what the desired resolutions are. So as a servicer, you have to ask yourself, who am I serving here, or what are our marching orders when you have all these different bondholders with different interests. And sometimes, whole loan or balance sheet, so they're not all in securitizations, but always a variety of interests. It's not borrower-centric either. There's no circumstance where the borrowers get to choose who services their loan or how they're going to have their loan serviced. They're kind of stuck with whatever they get. There's a lot of delays in the process. We've seen, complaint after complaint. I know in the loans that come into our own shop is mostly adversely selected, highly distressed loans, and the first call that we have with the borrower is usually a 30-minute counseling session where they talk about how they already tried to get a mod, or they've been waiting in line, or they thought they had a short sale and they couldn't get it approved. So you have a lot of borrower frustration really pent up and driving a lot of the complaints that are surfacing up to regulators. The economics just don't work anymore. They were built in a time when losses weren't expected to be what they are and when HPI is rising. Obviously, when you have a rising HPI environment, your workout strategies are a lot different. People can refinance. You can take the house and sell it. They can sell it before it forecloses. So you just have a lot more options. Now you have a declining HPI, rising delinquency. It's like the worst possible storm to create a pressure on the economics. Couple that with what banks and institutions, even non-banks, have bought MSRs for, they now have to write those down. For example, subprime MSRs on the old subprime securitizations are now worthless. They were bought at premiums. They're worthless now. They trade at a fraction of the advances. So a lot of economics wiped out on all fronts in the servicing world. factory-based operations just don't support the outcome design as needed now. Adam opened up talking, I think quoting Tolstoy about that every family has its own set of problems or some situation. It's the same with every borrower we see has a different situation. They need to get on the phone with someone that can walk them through all their potential options and all the workouts and find the one that fits their particular situation, and then get that approved by the investor if it's outside of the authority that we have as a servicer. So it's a challenging operational process. And it doesn't work in the old paradigm of timeline managed servicing where things sort of went down a conveyor belt. Along with 30 days, it was with one group, 60 days, another group. And now you see as a reaction to that, servicers implementing specific campaigns. They'll go do a mod campaign or a short sale campaign. But if the borrower fails in that campaign, there isn't necessarily a streamlined process to move them to another resolution strategy until the right one is found. And clearly, the speed at which these resolutions are found and implemented is critical in mitigating losses and would benefit all the stakeholders, but it can be a real process challenge. It doesn't fit that well into the traditional servicing model. So at the end, I would postulate that no one's really winning in the servicing game right now, and I wonder how you would attract new entrants. I think with the time we got into the servicing business, we got into a non-MSR model. We wanted to do all third-party, all distress, focus on workouts only, but unfortunately, even in our environment, not enough loans have moved out of the big servicers into smaller shops like ours, so we sit with a lot of capacity, and the resources that we have trained to help not really able to be fully utilized.
Amy, do you think it's possible that some of the smaller special servicers who have this capacity are in jeopardy of exiting the business due to the lack of volume?
Absolutely. Yes. I mean, it's unfortunate because even in the alliance of special servicers that we've been discussing and kind of trying to put together, it's a common complaint. A lot of these specials are out there. They have built all sorts of resolutions. They have, large capacity and good financial backing, but they just don't see the assets coming. Yeah, I'm sure some will exit the business.
Too bad they can't insource. Just go and set up shop within some of the larger banks.
Maybe they would. I'm sure they'd be open to it.
I mean, Toni, it's my impression that the critical problem the special servicers have is that they can't get to any of the loans that are locked up in private label securitizations. That those are kind of like roach motels. Once things go in, they don't come out, except in foreclosure. And that seems like that's a legal problem. And that strikes me as something that as a legal problem that could actually be cracked pretty easily. It would probably either take some legislation or some regulatory takings of assets. But that seems to me to be, if we think that special servicers are able to do the job better than the mega servicers, and the problem is simply moving product from mega servicers to special servicers, that's something that can be addressed pretty easily. Figuring out how to do it is easy. Whether there's a political will is a different matter. But the technical solution there of moving the product from the mega servicers to the special servicers, that's not a particularly hard process.
Adam, I agree with you. It seems so far that the administration and the regulators have been focused more on extend and pretend strategies rather than recognizing losses early. I would argue it's better to clear out early and get the distressed assets moved or resolved or modified or whatever as quickly as possible. But so far it doesn't seem like there's been a large proclivity for that. Would you agree? Is that what you've seen?
Absolutely. I think you put your finger right on the button here. That we are seeing the game has been extend and pretend, and just hope that the market somehow magically clears. And we've seen in every other market that was distressed in the fall of 2008, the market's cleared. We have not seen that happen with the mortgages themselves, and that's a real severe problem given the centrality of mortgages not just to housing finance, but to the entire U.S. economy. That until we get this market clearing, we're not going to see stability in housing. And you mentioned that New York Times article that was saying, we have 62 years, current pace, it's going to take us 62 years to get rid of the current foreclosure inventory. Well, this is just not the current method is just not a viable way of having the market clear. Instead, we should be having assets being sold off at a discount to, to buyers and having them clear. So, you sell that a loan is, say it's sold at 60 cents on the dollar to a special servicer who then writes down the mortgage to 80 cents on the dollar and does a refinancing, and it's win-win for everyone except for the bank that has to recognize the loss in the first place. But that loss exists any which way you deal with it. It's just, are you going to have to recognize it this quarter, or maybe you can string it out for another year. And maybe if the foreclosure system's really slow, you string it out for another 2 years. Or alternatively, having short sales. But we just aren't seeing those happening in volume, and that's really our problem. We don't have a market clearing mechanism that's working in the mortgage space.
That's true, and you saw, with the tsunami of sort of regulatory action. Who is your regulator is your first question you always have to ask yourself. And how many constituents do I have here? What things am I going to need to comply with? All of that creates cost and complexity and further pushes back entrants into the private space. And even those entrants that have come in with private capital that wanted to buy distressed assets, that would potentially buy them at a lower cost basis and have more flexibility in terms of workout strategies, they really haven't seen that much product. And I think until that happens, we're going to have a continued stagnation. Things are going to sit around, losses won't be recognized, but gains aren't going to be recognized either. Until there's some level of stability and clearing, there's not going to be the level of private capital required to boost asset value. And clearly at some point, housing values will be boosted by or diminished by the lack of liquidity. And right now you're seeing, less lending, higher cost lending, and all those things are going to continue to put a big drag on the housing values.
Let's go back to slide 25, how they line up. Okay, and from here, I really want to focus on a couple of the issues because we're starting to get into what are some of the potential solutions. So I want to go back to where's the real problem and where's the greatest threat. We've already discussed the consent letters. Adam, taking a look at this particular slide, where do you see the real threat? Is it the state attorneys general, or is it Schneiderman, or is it CFPB?
My sense is, at least immediately right now, that it's Schneiderman and Biden are probably the most serious threat for servicers. I would emphasize, though, that other than the OCC, OTS, FRB column, any and all of these could heat up in unexpected ways. That I think we have not come anywhere close to seeing the full extent of problems and litigation that will exist in the servicing space. I've been surprised at how slow some of this has unfolded, but I think we're going to just see more and more litigation pop up. And some of it might be investors. So we're seeing what's not included in the slide are all the problems that exist with LPS. And LPS is kind of this central node for so many servicers in that it handles so much of the default management operations for many of them that anything that creates problems for LPS creates system-wide problems. If I had to choose one of these, I would go with New York AG Eric Schneiderman for 200.
Adam, not on this chart at all is the lawsuits around the trust documents and the assignment of notes into a trust and whether or not the securitizations are valid. Do you think that is really being carried out, not just, I guess, on the individual borrower level to get out of being foreclosed upon, but do you think in any way that that's sort of an attack on securitizations as a whole to get some of these assets out of securitizations so they can have other resolution strategies?
I think that is ultimately the goal. So we've seen the chain of title arguments have been raised by borrowers up to this point. We haven't seen any actions by regulatory bodies that specifically focus on those. You can see some allusions to that in some of the problems there in the consent orders, but the consent orders are rather vague and they don't admit to any actual wrongdoing. I think you see it more in the Federal Reserve ones than the OCC ones, but if you read between the lines, you see some of it there. One of the questions is, exactly what will Schneiderman and Biden be going after? And I don't think it's coincidental, and they've played their cards close, but I don't think it's coincidental that those are the two attorneys general who regulate, from New York and Delaware. So most securitization trusts are New York trusts, And the remaining ones tend to either be Delaware trusts, and then there are a handful that are Massachusetts trusts. And Massachusetts has been active in a number of ways that haven't shown that aren't here. But having Schneiderman and Biden there, the attorneys general in those states are the regulators of trusts in those states, and they have responsibility to make sure that trusts are properly administered. And any problems with assets not being properly transferred into trusts, and therefore assets leaving trusts, so forth, would fall within their purview. So I don't think it's coincidental that it's Schneiderman and Biden who've kind of split off from the rest of the AG pack. And we publicly, at least, it's not clear exactly what they're pursuing, but it would not shock me if chain of title is part of the package. I think they have a real problem, though, in dealing with chain of title. Chain of title is sort of a nuclear option that I think they have, or at least possibly the ability to really blow up the whole industry if they wanted with chain of title problems. I'm guessing my friend Larry Platt, who I see is an attendee, will disagree with me on the legal aspects. But if I am right on some, frankly, undetermined points of law with chain of title, we have a serious problem throughout the securitization industry, where we have basically a bunch of non-mortgage-backed securities. We don't have any legal decisions that are exactly on point saying that for sure. But if I'm right about a few legal questions that are not, where the law is not clear, we have a real serious problem there. That's something Schneiderman and Biden can push on. But doing that's like dropping a nuclear bomb. And the challenge for them is going to be to figure out how to turn this strategic nuke into a tactical nuke. I don't think that they want to bring down the whole industry. As I said before, I think their goal is presumably to use problems like chain of title and robo-signing to extract concessions on the resolution side. And that's a matter of negotiation, and to some degree it's playing chicken with servicers. Who's going to blink first on it? And I don't know how the AGs are going to figure this out, but that's their challenge there, is going to be figuring out how to turn the chain of title issue into a practical issue. And it's been a problem for investors too. That mortgage-backed security investors, at least the sophisticated ones, understand the chain of title issue extremely well. They are not, they're not just, you've got plenty of investors who have not paid any attention, but the sophisticated investors who follow this space, I've been surprised, the ones I've spoken to, many of them know the problem in more detail than I do. And many of them are convinced it's a very serious problem. But the difficulty they have is they don't have a trading strategy with it. That if they're already invested in mortgage-backed securities, there's not an easy way to get out of this stuff if they have large holdings. And if they're not invested, there's not an easy shorting strategy here. That you could, in theory, short the bank stock and try and encourage massive putbacks. But that's any kind of shorting strategy like that's risky. And frankly, it's a case where you're trying to hit a single or a ground rule double, not a home run. That if you get too many putbacks, you bring down the whole banking sector, and then you don't get any recovery. Or your recovery becomes a matter of what Congress wants to do politically with a bailout. So this is I think a real problem for same problem that the AGs have is a problem for investors. They know they have a legal issue to play with, but it's figuring out how to get this so that it actually gets the returns they want and doesn't become too big of an issue.
What is the return that they want?
Investors?
No, I mean the agencies that are involved in these investigations that are using these procedural arguments to either to create a nuclear option and blow up securities or to put pressure on servicers. What is it that they really want?
I think they're not totally sure what they really want. I think that there's not a unified vision about what they really want. That's part of it. I think if you were to ask them, the general things they would be saying are, we want to see more modifications happening. When the borrower is able to pay something that's market rate, the borrower should be able to pay. The mortgage should be reduced to that, and the borrower should be paying more market rate mortgage and stay in the house. Now, they have no idea how many borrowers that actually describes. And I'm not sure that anyone has a great idea how many borrowers that actually described. But there's a strong sense that there are many modifications that should happen that aren't happening for all kinds of reasons, from simple, operational incompetence, things like, servicers using fax as their primary mode of communication. Well, gosh, you get 40,000 pages of fax coming in a day, of course you're going to have some problems. To incentive alignment problems where, it might just be more profitable to foreclose than to spend the time trying to do a workout. To just the nature that there's an incentive to do interest rate reductions rather than principal reductions. So, I'm sorry, please go on.
I would say I think it would seem like a better use of time and resources to just take a direct action and perhaps legislate rules around modifications or whatever the desired outcome is, rather than pick around the fringes and have resources, time, money being put into areas that really doesn't get to the core of the problem that we're trying to solve.
I agree wholeheartedly on that. But I look out my window and I see the Congress building, the Capitol building here, and I have zero faith that the current Congress would be capable of coming up with anything close to an agreement on what a modification process should look like. If you think about just the acrimony that existed over HAMP, which is, in theory at least, a voluntary program, but HAMP's terms didn't make anyone happy, and those were terms that were set by the executive branch, in somewhat in negotiation with servicers, but ultimately it was the executive branch's decision what those terms are going to be. If you had to try and negotiate that in Congress, good luck. I don't believe either party would be able to find much internal agreement, much less agreement between the parties.
We actually have a really good question. And by the way, Larry Platt, I asked for a personal favor and appreciate the fact that you actually showed up. The question is, do you think current borrowers should have their loans written down as well to the fair market value of the property? If not, why should only delinquent borrowers get the benefit? And if so, what does that mean for the larger industry? Adam, you want to field that one?
Well, my view of this is completely unorthodox, and I don't think anyone would agree with me on this. I think that the modifications the borrowers who should be targeted for modifications are the strategic defaulters. So exactly, the guys who everyone hates, those are the ones who actually should get the modifications. And it's not because I like them, it's because those will be the modifications that will be the most effective. And those will be the most effective because those are the guys who have shown that if they're underwater, they'll walk. So if they're not underwater, they're going to stay. That you're going to get bang for the buck there. If it's the homeowner whose hours have been reduced or who's been laid off, they may be incredibly deserving and sympathetic, but you don't know that mod is going to work. And so we get this, in my view, that the morality of this runs completely counter to the economics of it. And I think this kind of puts front and center the real problem here, which is we haven't decided whether the way we want to deal with foreclosures is as some sort of disaster relief mercy mission, in which case, find the most sympathetic borrowers, find, grandma who was about to retire and her life savings were invested in one single mortgage-backed security and it got wiped out, and now she can't make her mortgage payments and she has health, whatever sob story you can come up with. If we want to do a mercy mission, target those, sympathetic investors and figure out, homeowners and figure out some way to identify them and target them. But that's simply about, feeling good about ourselves, that we're going to be merciful and charitable and take care of the most vulnerable in society. And I think there'd be nothing wrong with doing that. But I think there's actually a much more important reason to do loan modifications, and that is as part of kind of macroeconomic stability and recovery. If we want this housing market to recover, we need to put the brakes on housing price declines. And you can't do that without reducing the foreclosure inventory and you have to stop the bleeding and mop up some of the blood. And you can't do that without doing loan mods. And they can't just be interest rate mods. We've seen interest rate mods, some of them work, but if you start modifying principal, you're going to have better results. You're going to be able to take care of your strategic default problem if you start doing principal write-downs. And it's not about any kind of morality or justice. It's about solving a macroeconomic problem. And if we have to reward some jerks as part of that, that's part of the price of it. And that's unfortunate, but that's that's the way the world works. And going forward, we may want to think about drafting mortgage contracts differently so that that strategic defaulters don't have that kind of leverage, but those are the contracts that exist now.
Do you see?
I thought we were going to be unorthodox.
Well, actually, there are a couple of people who actually totally agree with you. It is so difficult to get beyond the morality issue of it. I think it's almost against human nature to say, okay, let's give the jerks the reward.
Except, you look at it's funny, we deal with credit or with consumer credit so differently than we do with business credit. That just to take for example the Mortgage Bankers Association, I might be a little wrong in my details here, so please don't cite me for this. But I believe that they ended up walking away from their underwater headquarters building, and no one thought, oh my God, what an immoral thing. It was a business decision. Yet if I were to do that, my God, I'm this ruthless defaulter, this terrible person who is stiffing the bank, and it's a phenomenon that exists, but I don't really understand why we treat credit as a moral issue for consumers but not for businesses. My view is, look, a contract's a contract, and there's not a morality about contracts. It's you do the duty, you pay you do what you said you're going to do, or you pay the price. And if the price is giving up the house, well, if you give up the house in exchange and the debt's gone, well, that's the deal you signed up for. And if the lender doesn't like that, they shouldn't have signed up for the deal. And presumably they price that into the deal.
We need to start wrapping up just a little bit, and I wanted to encourage the audience, if you have some comments now, we're going to talk about possible solutions. Adam just mentioned one of them, which was actually to do the modifications for the strategic defaulters. But with the regulatory and legal actions, the industry is now in a complete state of paralysis, as I see it. Buyers don't want to buy homes because the prices are coming down. Lenders don't want to lend. Investors won't return to the market until the servicing issues are resolved. The foreclosures at the current rate are estimated to take 60 years to clear the system. The government's running out of funds to rescue the housing finance system, and the longer the housing system is broken, the more it weighs down an already bad economy, and now the derivatives are about to hit. So does anyone see any way out of some of this? Amy.
Well, I do think that there are a lot of investors and firms that have the ability and the capital to buy distressed assets, to do workouts that don't include foreclosure, and not even terminal workouts, to do more principal forgiveness, modification. Another good one that we've started to see pick up a little bit lately is the short refinance programs from FHA. That's really the only place where I've seen principal forgiveness to performing borrowers, and that happens primarily motivated to get a return of capital, and then the investor is able to recognize a return, and the borrower gets a good deal, and that they have a new mortgage reset at a lower principal, and then they can have now options if they need to move and things are not locked and stay in the house. Yeah.
Amy, do we know any numbers, volume numbers for that? I haven't seen any yet.
They're pretty low. I mean, I don't think there's been a lot of it. I can't give you exact volume numbers, but so far it's been pretty slow to pick up. I think there's been concern on the side of the originators as to how the performance of these assets is going to affect their compare ratios. So it's been a little bit slow, but it seems like it's starting to pick up. I know we're doing, for the size of our portfolio, we're doing about 5% of it last year. I think that's going to probably double this year, so maybe 10% of our portfolio will get put through that strategy.
Is there any reason to think this is going to do noticeably better than the Hope for Homeowners program? I think that closed all at 100 loans.
Yeah, there was a lot of issues around the guidelines, how to underwrite the homeowners, it was really, really challenging and a very long process to get one of those underwritten. So it kind of got abandoned as too costly and too difficult and too much risk to the originator. So the FHA short program has kind of overcome some of those obstacles and looks like it might have a better chance at success. So we're seeing more go that way now. I think they have up right now that slide of how much of our portfolio went that way.
Sorry, Amy. Adam, do you think that with the current trajectory of the Schneiderman-Biden actions, that there's any potential to actually change some of the law moving forward with regard to securitization?
I would be very shocked to see any major legal reform happen before the 2012 election. That I think that going forward, Congress is going to be so polarized that absent a very acute financial crisis, it will be unlikely to see it for them to act. And even if, and it frankly kind of worries me that if we do have an acute financial crisis, then it might be harder to get resolution out of this, some kind of resolution out of this Congress than out of the one we had in fall of 2008. But if you recall, in fall of 2008, the House, initially voted down the what became TARP. Then they went back and they a week later or so they passed it. I think that this current Congress would be less likely to approve anything that looks at all like a bailout, even if there are no federal dollars involved at any point before the 2012 election. Which means that we're kind of in a dangerous period where the federal regulators have the tools that they have at their hands, but those are probably not going to be sufficient tools if everything happens to blow up in that time window. And I should say, to answer your original question, Toni, I don't see a real solution to any of these problems that doesn't ultimately go through Congress. And I don't think that anyone is moving real fast to take this to Congress. That the financial institutions, the last thing they want to do is go back to Congress and ask for assistance right now. Because that's pretty much sticking their head through the guillotine slot. So financial institutions, the banks aren't going to go to Congress. The homeowners have no ability to get anything moved in Congress. And that means unless things get really, really bad and there's some kind of acute crisis, an auditor won't sign off on a major bank's financials, you get a court order in California that shuts down foreclosures or something like that. Unless you have some very acute crisis like that, I don't see any change. Instead, it's just going to be cut after cut after cut to the system, and that 62-year pipeline of foreclosures is going to grow to a 100-year pipeline. That the foreclosure timetables are going to get longer, not shorter.
I wanted to mention to all of you, we have a recommended reading section on the website, and I wanted to encourage you this is where you can also download the presentation. Someone was asking me how you can get the presentation materials. They're there as of next week. In the meantime, I really encourage you to download the OMSI proposal, which has some incredibly bright ideas for some potential solutions to all of it. Not without their problems, but it's certainly worth reading. And then before we close, Amy, you had mentioned something about a special servicer alliance. What are the chances of that actually gaining some traction?
I think the chances are pretty good. We continue to meet and make sure that our interests are aligned and that we have some issues that we all feel strongly about and think that we could add a voice and potential solutions. As when you ask the question, what are the solutions, there's kind of a silence for a minute. The issues are so complex. But the special servicers do believe that they have capacity and they have the ability to help accelerate resolutions and to move this along. So I think we're gonna be able to form something and get that voice out there.
And do you think you'll create a white paper?
I think that we would definitely look to create a white paper that demonstrates how special servicers are able to help. We're saying it, we need to show it. We need to show the amount of resolutions that we're doing, that we're resolving our portfolios in 3 to 4 years. We're getting 35% of them resolved a year, mostly not foreclosure. And I think that there's a really good story there, and it needs to be told.
Awesome. Sorry, I'm sort of priming you, but I think it's a really interesting development, certainly. I'd like to thank Amy and Adam for being here today. This is a huge topic, and I'm sure we could revisit it several times. But we've got the timeline for you to go back to and take a look at, and as I said, we'll keep it updated. At the same time, you'll be able to have all of the slides that you can follow. This is a topic that one could never cover in an hour and 15 minutes, but I really appreciate Amy and Adam giving some color toward that. And I really want to thank you all for taking the time to be with us today, and we certainly appreciate it. We look forward to seeing you at the next quarterly webinar. Thanks very much. Bye.